I'm Avery Crosley, the new client assistant here at the Utica branch. We are going to talk to you today about financial fitness. Behind the camera is Jessica Parknell, the other client assistant who's been with us for 6 years. To my right is the new financial advisor on the team, Michael Hayduck. And directly across from me is Teresa Flemma, director and CFP. She has also been named by Forbes as Best in State Top Wealth Manager, as well as America's Top Women Wealth Managers. So our goal today is to cover some financial strategies that will help you with your financial stages throughout life. One of the first steps to life's financial stage is having a child. Teresa, could you tell me something that you could put in place for a new child and financial planning?
Avery, that's a great question. The first thing that comes to mind is a 529 plan that allows people to put money aside for college. And with the cost of college, it's so important to start as soon as you possibly can. And it's something that a grandparent can do, a parent can do, an aunt, uncle, a family friend member. And the way it works is once you put money in, you let it grow tax-free, as long as you use it for college. So when the child goes to college, and you can take it and withdraw the money at that point, and what happens is it comes out tax-free. Now the worst case scenario is the child doesn't go to college, and you still want to take the money out and give it to the child for, let's say, their first home. Well, then you have to pay taxes on the interest for the 10% penalty. But it also they can wait, and let's say they want to go back to school when they're 45 years old. They can use it at that point. There's no age limit to it. Now the thing is that every state has its own 529 plan. And it might have benefits. For instance, if you use New York State's, one of their two plans, you can deduct the first $5,000 that you contribute to a 529 plan up to $10,000 if you're a couple. And that's against your New York State taxes, which is a 5% savings usually on your taxes. So that to me is one of the best things to do, that you can, when you're buying diapers and gifts for a newborn, add something to the 529 plan as well.
Teresa, thank you for your detailed response. Now let's move over to Mike. Let's say that this child has now started their first job. Do you have any recommendations for their financial future once they get to that point?
Avery, that's a great question. So I think there's a few options that we're going to talk about today, but I think the first we're going to go through is a Roth IRA. I think Roth IRA is a great way to save at your age. You're most likely in a lower tax bracket than you will be later on. So this money that you put into a Roth IRA is going to be after taxes, different than a company-sponsored retirement plan that would come out from your paycheck. This will come out after your paycheck and you would hit your bank account. Look at a Roth IRA as kind of a savings account that's tax-free. So any money you put in there, you'll be able to access without penalty starting at 59.5. Any interest made in the account, it will not be subject to capital gains. And when the money comes out of your Roth IRA, it has already been taxed when you're at this age. So when you're in your 60s or 70s, that money will come out tax-free to you. And over time, we're going to see that money grow, and it'll be something that you can just put away and basically forget about.
Mike, great. Thank you for that answer. When starting out a Roth IRA or an IRA in general, what percentage do you recommend to put aside into your IRA accounts?
That's a great question, Avery. I think what we recommend is 10% of your salary. But that might be hard for someone early on in their career. So it's good to start small. Maybe $50 a paycheck, maybe something bi-weekly or monthly. But every time you get a raise, put away half of that raise and increase your percentage you are putting away into your Roth IRA until you reach 10%.
Mike, thanks. Let's move on to what you would recommend for someone who has transitioned from their first job to making a step in their career.
Avery, that's a great question. So there's a couple options here. Do you work for a company that has a company-sponsored retirement plan, or are you self-employed? We'll get into some options here, but one of the most popular ones is you work for a company that has a sponsored retirement plan. Very popularly, they'll be, if you put away up to 3% of your paycheck, we'll match 3% with a dollar to dollar, so 100% match. So what that means is you put away 3% of your salary, they will also put in an additional 3% matching what you did. And I think what's important here is to take advantage of that match as much as possible, right? That's essentially free money your company is giving you to put into your retirement. So in essence, you're now saving 6%, right? I think the next thing to do is, if you are self-employed, there's ways to, just like we talked about with your Roth, there's something very simpler. There's a SEP IRA. It's a self-employed pension. And what that does is you can save the same way as you would with the traditional IRA. You can just save more in a higher percentage it's more allowable by the IRA because you are self-employed and that's your way of income, and you can match that as well through your company.
So Mike, you recommended putting 10% into your Roth IRA. Would you recommend doing the same for your retirement plan?
Yeah, I would with this company sponsored plan or with your SEP. I would put in at least 10%. That's what we would recommend as you start earlier. This is the first portion of your retirement planning. We have more as we'll discuss as we go here. But this is the first step. And as you put in money while you're younger, it's only going to grow more over time, as we talked about the time value of money. And I think this is a great start, putting away 10% for the rest of your future. And this will help as you get into your retirement age, because I don't think you really want to work forever. But the one thing to note with this is all going to be pre-tax money. So you're, in theory, going to be in a higher tax bracket now than you will in retirement. So you take it tax-free now, or when you withdraw on it over 59.5, that will be subject to taxes, but will be at a lower rate than you are now.
Thank you, Mike. Teresa, do you have any suggestions regarding estate planning?
Actually, I do. Estate planning is one of the pillars of your life cycle, your financial wellness and fitness. It encompasses so many different parts. But let's talk about the documents you should have for your estate plan. One is a will, one's a power of attorney, one's a healthcare proxy. You may or may not need a trust. This could be a conversation for hours. So I'm going to try to just summarize what you need. The will spells out upon your passing where you want your investments and your belongings to go and to whom. If you pass on without having a will, then it's going to be dispersed by the rules of the state that you live in. And that might be going to people you don't care for, and you don't particularly want them to receive any part of your estate. So it's important to have a will. A power of attorney is somebody that you appoint and you trust explicitly, because that is somebody who can act on your behalf while you're alive to handle any financial aspects that you may or may not be able to handle for yourself. The Healthcare Proxy living will, it's 2 parts in New York State. The Healthcare Proxy addresses in the event that, let's say, you get in a car accident and you can't act or talk to the doctor yourself to say, oh yes, I want the surgery, or no, I don't. The Healthcare Proxy is the person who acts on your behalf and talks to the doctors on your behalf. The living will covers you're terminally ill, you're ending a life stage, and this is the person, for lack of better words, pulls the plug and says, yes, these are your wishes, and follows your wishes out. And so those are really important. Again, the person you select in each one of those areas is extremely important. Going from there, you have the difference between, you could have a trust. If you have a trust, they're usually revocable or irrevocable. What's the difference? Revocable trust you can change anytime you want to. And irrevocable, much harder to make any changes to it. So once you put money into an irrevocable trust, it pretty much needs to stay there. When you have money in an irrevocable trust or a revocable trust, it does not pass by your will. So your trust has to spell out, again, your wishes. And you need to name a trustee, so when you can't act for yourself, that this trustee takes over and covers and does what you want to do and what's spelled out in the trust. From there, the important thing to have is making sure that your IRAs have the correct beneficiaries. If you have an investment in your name only, you can add what's called transfer on death, also known as payable on death, also known as in trust for. They all mean the same thing, and what it means is that should you pass away, you want that particular investment to go to that person or that charity, which makes it nice. And again, that would not pass. It's like having a beneficiary, so it does not pass by your will or your trust. In a nutshell, that's about it as far, without really delving into things in much further detail. To me, it's extremely important for you to have your professionals behind you which would be your attorney, your accountant, and your financial advisor. Those three, should be working together to make sure that you're on the right track.
Thanks, Teresa. Mike, is there any other way that you could leave your investments directly to a charity organization?
That's a great question, especially in this time. We get a lot of questions about that. So a couple ways are you can just give it outright from your investments. That's one of the easiest ways to do it. The next way is to come up with a charitable remainder trust, which is a little more complex. We'd like you to contact our office if you're that sounds like it interests you. And the third way is if you're slightly older, above 70 and a half, you can give a donation, say to the American Heart Association, right from your IRA, tax-free, which is something that I understand you probably want to take advantage of.
So we are nearing the end of our segment, so I just have one more question for Teresa. Do you have any other suggestions for helping people with their financial fitness?
Avery, I've been a financial planner for a long time and have met with many people and worked with them through their financial fitness and their life stages. One of the most important things that I can say is that as you get older, you need to bring in your loved ones and talk to them about your wishes. Let them know who your financial advisor is, who your accountant is, who your attorney is, because in the event that you should pass away, they're under a lot of stress. And if they know where to go, it makes their life a lot easier at that time. Now, a couple of things we have to help is what's called a family love letter. And you can Google this. It's a pretty standard brochure. And what it does is it spells out whether you want to be cremated or buried, who all your top professionals are, if you have a safe, even if you are incapacitated, then what your medications are, who your doctor is, all the information that's important for somebody to know at that point. Now, if you don't want to Google it, we have this. It's called A Financial Letter to My Loved Ones. And if you would like a copy or two, please feel free to call us at 315-738-4564, and we'll be glad to mail you one.
We just want to say thank you to the American Heart Association for giving us this opportunity to talk about financial fitness. If you have any additional questions, please don't hesitate to give us a call at 315-738-4564. Thank you for watching.